This conference will now be recorded.
Good evening, ladies and gentlemen. This is Clueless Day Trading Frank. It's approximately 10:26 p.m. on Sunday, May 17th, 2020. Welcome. I do sincerely apologize for the delay in starting the Sunday strategic webinar. Had some important family issues that we had to take care of. Everyone is fine. Everything is good. But responsibility comes first. So again, my apologies. Anyways, everyone can hear this video when it's uploaded on GoToMeeting webinar link very shortly after we get done. I'll try to keep this very short, this session. And of course, you can listen to it on YouTube when it's going to be uploaded either later tonight, if not by very early tomorrow morning before the market begins. So yeah, you can listen to it at your own time. Full disclosure, this is purely for financial education, not for any solicitation or advice. And again, welcome. So what we're seeing tonight in the Globex futures markets, that's the world markets as they've opened, Asian markets, Australia, Hong Kong, Japan, and such, that we are having a pretty ferocious upside move as forecasted and alerted to all my members on Friday. We do have some very minor hedges, which didn't work out during the day on Friday. And as we know, we have those hedges just in case we open down 32 handles or 33 handles on the E-mini futures, that we are up right now, not down, for reasons which are well known to a lot of people. I did post that on the Twitter feed a short while ago from my mobile phone, from my iPhone, and that has to do with Fed Chairman Jerome Powell, who I didn't know was going to be on 60 Minutes, the program on CBS, I believe. So he made some, in his own words, he made some optimistic comments, cautious that he is. After all, he's the Federal Reserve Governor. But that sparked off a pretty sharp rally, and we are up right now 32 handles or 32 points in the mini futures at 28.79 approximately, give or take a few cents. And everything's looking very strong for the opening tomorrow morning. Now, keep in mind that on my Twitter feed on Friday, we had some very powerful winners on selective stocks, and we set up some good positions going into this coming week. And I mentioned some very simple things here, and one of them that all of you should remember is that Memorial Day week, which is this week, and going into Memorial Day week, we do not normally, generally speaking, barring unforeseen black swan, unquantifiable events that we're all used to by now, even though we don't like it, is a positive week. And that is what's shaping up to be. Whichever the case, all those powerful setups on the IWM calls, Russell 2000, US small cap, and the SPY calls are going to, and of course, selective individual stocks that I have suggested are going to open up very strong, barring any unforeseen events, mind you, overnight. So saying all that, one thing I did notice, and I've been pushing this lately for the last couple of weeks, that with the reopening of the US economy, the biggest short-term beneficiary and the biggest catch-up is going to be on the Russell 2000, which is domestic, and the IWM is right now up 2.5%. The small cap futures, Russell 2000 futures, is up 2.5%. Unfortunately, I cannot show that on Thinkorswim because they, for some reason, do not show that for a while now. And so that's the reason when I put in /TF, Russell 2000 mini futures, let me see if it comes out. See, it doesn't show that. Whichever the case, IWM right now is up a good solid 2 points, and it's up 2.5% on futures. Now, keep in mind that I have stressed that the biggest beneficiary, I repeat again, of the initial reopening of the US economy, beautiful weekend this weekend, a lot of people out, especially in the big stores, the Home Depots, the Lowe's, and all that type of stuff. A lot of cars on the road. New York opened up partially, a lot of people out there, and that's my neighborhood. And obviously there is this surge of human euphoria, and generally speaking, the first beneficiary of that is the U.S. domestic economy, and that is the reason why the small cap Russell 2000 futures are up 2.5% versus the S&P 500 futures, which is up 1.2% or 1.19%. So look at it. It is the Russell 2000 futures that I've been suggesting very, very strongly is up close to 60% higher on a percentage basis than the broader indices such as the S&P E-minis. The Nasdaq is up 1.1% right now. The Dow Jones Industrial Average futures, Dow 30 futures are up 1.2%. And I repeat again, the Russell 2000 is up 2.5%. So
Nice.
numbers speak volume. That's all I'm trying to say. Numbers speak volume. Now keep in mind the Russell 2000 that I've shown repeatedly, and of course I'll show tonight again, is the one that has to play a significant catch-up. And generally speaking, it is full. One of the reasons the Russell 2000 has lagged the major indices is because it's and it hasn't lagged over the last a week or so, as you guys very well know. All right, those 200+% type of gains, 120% type of gains intraday on the Russell, on the IWM calls that we buy, and the 200% type of gains on an overnight basis are coming on the backs of a resurgence of tactical institutional money, the hedge funds going into small regional banks, the financial sector, the biotech sectors, a significant amount of small biotechs which have rallied tremendously. We have participated in a bunch of them and are still participating in them, are in the Russell 2000. U.S. small cap index. They're not in the S&P 500. They're not in the Dow Jones Industrial Average. They're not in the NASDAQ 100. Okay, so just keep that in mind. So saying all that, those are the big leaders, but then the small cap, the smaller leaders are catching up. So we're just playing we're just basing the arbitrage game here, and over the short term, I believe the IWM has a and because of reasons that I just explained a few minutes ago, will have a larger profit potential, and has had larger profit potential, as I've shown repeatedly, over the near term. So I just want you guys to all keep that in mind. So so saying all that, we are going to so what we're seeing, what you're seeing behind you right now. Let me try to expand this a little bit more. What we are seeing is, there we are. So this is one of my tactical charts. As I showed, this is the 1 hour chart, and I've been pretty much dead right on these volatility moves, as you all know, and it's a matter of let's put it this way: the average retail trader who is not accustomed to really understanding the power of these fantastic real-time tactical charts, especially the volatility movements on an intraday basis and such, that I publish every single day, many times. The ones who are not used to it, they're basically going with the gut feeling. And the gut feeling generally is wrong, not necessarily because of their fault, but primarily because the algorithmic high frequency trading black box supercomputer programs are designed to make sure that they're the least amount of positioning or participants on one particular side. In this case, obviously, majority are significantly bearish. There's no question about that. The most recent American Association of Individual Investors readings showed more than 52% almost of bearish investors, which is unheard of. But hey, We've seen it happen before. And the less than or 25% or less than that bullish investors. So if you really want to be a contrarian, ask yourself what side of the odds you want to bet on, right? So majority talk a lot of there are a lot of bullish. There's a lot of bullish retail traders, but they're just bullish they're just basically just fake bullish, all right, for a better choice of words. They are talking the talk, but they're not walking the walk, all right? And they say, hey, yeah, I'm bullish on the market and stuff, but they're not positioning themselves. Now, the same thing, by the way, is happening on a wide scale basis on the institutional side, which I have explained many, many times, where hedge funds, large institutional investors, even the Warren Buffetts of the world to a certain degree, and then you got the Ray Dalios of the world, and all those people, Paul Tudor Jones, even Tepper, who is generally a very bullish equity guy, Mark Tepper, Appaloosa Management, David Tepper, I believe, right? So they have been talking down the market. They've been talking down the market. Now, a lot of the times they talk down the market because they're net short on some large positions, S&P futures or whatever the case may be, and they basically want to talk their they're talking their book. They're scaring the living daylights out of the average American investor, who is actually so scared anyway that they're not even in the market. But just the overall trading community, for example, and they're basically scaring the living daylights out of them, and that initially is causing these large moves down, up and down on the market, and they're making money. They're making money. Remember, this is a business of making money. So if you go on national TV and you tell the world that the market is almost as overvalued as this in 1999, which I do not believe whatsoever. That was kind of the give or take a few years when I actually started in the stock market, and I was just learning, how the game works when I first started on Wall Street. So what the heck do I know? But they're saying, oh, it's almost as overvalued. I think that's complete garbage. And that was validated by Nelson Peltz, another big, very serious multi-billionaire hedge fund guy, who came in the next day after we did the webinar the night before, and basically said, no, he doesn't think the market's overvalued. He does think that there are pockets of overvaluation, which always happens. There's always going to be 5 or 7 stocks that are going to lead the market. That's just the nature of the markets. And there's going to be a bunch of them which are going to be lagging. And you want to play the ones which have the highest potential. In this case, the Russell 2000 was lagging, and now it's playing catch up. And it's got a long way to go, as you all know, because I've shown that on my charts. Now, will it happen? Well, we'll see. In the meantime, while people say, "Oh, we'll see," we're making money. So that's my business, okay? And I'm trying to help everyone try to understand that. So basically, one of the key things is that you really need to have an element of hope, have an element of belief. Like President Trump tweeted out today, that America was built, and I said this many, many times, on grit, on hope, and grit and hope. Okay, we don't not on doubt and fear. All right, if we wouldn't be in the United States of America if in our history, if we just grew on doubt and fear. I mean, if you think about it, so many Americans, both mom and pop investors as well as the institutional side, and Wall Street included, are so bearish on everything all the time. I mean, seriously, all the time. All right, that like I said, it gets boring. It's sad and it's boring. And President Trump nailed it. To be honest with you, like, these guys are all big shots. They're all talking their book. And on top of that, how long can you stay scared? How long can you miss humongous returns that are being delivered? Selective alerts, which, whether it be the earnings plays like Wix, that I've never played earnings, and that options went up and then went up again the next day. All right. And that stock is making a new high over and over again, and so many others, so many others. So ask yourself before you go to bed tonight, like, how long are you going to be a sheep? Like, really ask yourself. I ask myself. I'm not a sheep. I'd like to be a lion all the time, but I think compared to the rest of the investing universe, I'm a lion. And I'm not like some stupidly bullish guy. I get tactically bearish and we make money on that, but that's a very short-term thing because this is a bull market to a certain point. So ask yourselves, how long do you want to live in fear? How long do you want to be scared? How many times do you want to miss profits, make complaints, excuses, and see other people making serious money? Those are very few, by the way. So you want to be with the majority in the bunkers, and not, in the bunkers, buying diapers and just lying around complaining that everything's going to hell in a handbasket, hanging around in trading forums that are always pissing on the U.S. economy, and not understanding the power that you never fight the Fed, not with the level of firepower and ammo that the Fed has delivered and the government has delivered, and more bills and the phase 4 of the stimulus bill most probably will get passed on a slightly watered down version, okay, which was passed by the Congress, and now the Republican-led Senate is discussing it, and a part of it will, will be approved. So how long are you going to keep on saying, no, it's all, figment of my imagination, they're just printing money? Who cares if they're just printing money? First of all, they don't print money. It's a balance sheet adjustment, okay? So I find it very dumb when traders say that, oh, they're printing money. Yes, there's a printing press out there printing money. Like, give me a break, all right? We're borrowing money from ourselves, and we'll deal with it. And we have interest rates at historical rates at 0.64%, the 10-year government bond. So we could refinance our debt over and over and over again at 0.6% on a 10-year basis. And not to mention the government's thinking of rolling out 50-year and 100-year bonds. So when people don't understand, and especially retail traders, they have absolutely no freaking clue, okay? They have absolutely no freaking clue, honestly. I don't care how good a trader some is on a short-term basis. They don't have any frigging clue of monetary and fiscal economics. So how long can you keep on pissing on Jerome Powell as if he's like some dumb idiot who doesn't know what he's doing? And on top of that, we have it coordinated. And keep looking at this chart, okay? Keep looking at this chart. This is futures up 35. We're going to be here. We're going to be at 29.64 this week. High probability move. And if I'm wrong, which I don't think I'm going to be, and I know what the downside is. And I told you guys this was a reversal hammer. I told you that we were reversing on Friday. It's all there for people to see. So the point is, you can sit there and debate. You think like you're some Harvard economist or PhD in econometrics, which most people don't even know what it is. From Princeton or University of Chicago, but you're not. So in lieu of that, why don't you try to understand these charts? It's really that simple. And if you understood this chart, you'd make a heck of a lot more money than you're doing right now. You'd be losing a lot less than you're doing right now, because most of the times you're losing is because you're panicking and selling. You're not dollar cost averaging. You're not buying into reversal plays. And that's because you have a mental virus, and it's called fear. The mental virus humans have is called fear. I'm not saying I don't get scared sometimes. Sure, if a large position upside down, yeah, I get pissed off. I never panic. If I'm going to take a loss, I take a loss. Traders have to take a loss when they have to. Sitting around the same position, which is not working, technically broken, is the dumbest thing ever. And many traders or some traders do it. So if you want to keep on doing it, that's not my business. You got to shift money. Money is fungible. You guys know what fungible means, right? It's not a fungus. What is money is fungible? What does that mean, Rob Anderson? And Rob, next time get a mic if you don't have a mic, because I can be looking at the chat screen, seeing like if anyone's asking questions. So Can somebody tell me what fungible means?
It's replaceable.
Right, and it can change, it basically is fluid, right? It's replaceable and it's fluid. So if money is fungible and it can go, from one form to another, then then you'll just read up why they call money is fungible. Okay, I can understand when some people don't quite understand it, and I'm not going to sit here and explain that. So the bottom line is that, and thank you, Mike. So the bottom line is that that given the limited reopening of large, high-producing parts of the United States of America, which is mostly the West and the East Coast when it comes to the financial world, the tech world, and stuff like that, they're limited opening. And then the middle of America will, industrial part will move up. They're going to open up the car plants and everything, and you're going to see a surge. Doesn't mean we're going to make new highs. I never said that. I'm simply saying that, and now we get into the technicals, that we are going to basically hit this mark again. And more importantly, just to remind everybody, let's get a pen. Okay, we have a very large, defined, very volatile, mind you, very large, defined cup and handle with a trading band. And I've showed this. And that trading band is wide. There it is. 2,700, and on the upper end, it is, to be exact, it is 2,962. That's a large trading band. That's 162 handles, okay, times roughly 8. That's 1,300 points on the Dow. So if you know that, then you want to take advantage of, and then there's an intermediate trading range of 2767, which is a retest of the 34-day moving average. I must have posted it at least 4 times since the 14th. On the 14th, I did. Okay, that's a beautiful hammer. And now another.
It's on the 50 fib as well too, Frank, as your one-day chart shows.
Of course. We're going to look at that. The fib 50 support is immense. Absolutely. Thanks, Paul. Yeah, but we're looking at the basic moving averages here. Like, you don't need to be a rocket scientist. You don't need to know like advanced technology. But look at this. All you have to know is candle structure. You have to look at the internals, the stows. You have to look at the McLaren oscillator to a certain degree. And you have to look at whether this line, this 34-day moving average, if it had violated that, then we would be in danger of retesting 2,700, which is the lower end of the trading range, which would be roughly very close to the 50-day moving average on the, and we're looking at the live E-minis, the live organism, right? So bottom line is that that we have a 1,300, what was I going for? I was going for the pen. We have a 1,300, okay, writing it down here, 1,300 band that the market, this is the handle, this is your cup, and that cup's handle is 1,300 Dow points. That's quite a bit. That swings around stocks big time, especially the leading stocks, right? So you got 1,300 Dow points that the market has been traveling in, realistically speaking, since late April. That's three weeks, 3 weeks ago. So does this really, to me, and I've said this repeatedly, to me, it doesn't look like, unless one side breaks, that's a different story. Then we got the next level of support at 2,400, 2,500. Those are different stories. But why predict the massive negativity given what is happening on the external side with the news flow, with the reopening of the US economy? It's really as simple as that. With companies coming up with novel clinical trials of vaccines, with the Fed and the government pushing trillions of dollars into the US economy. So why go for the heavy duty negativity? Because Jeffrey Gundlach, who's actually a bond guy talking his book, is telling us that we're going to retest the lows. Yeah, we can possibly retest the lows, but why predict that if the technicals haven't broken? Ask yourself that question before you go to bed. Those guys are talking their book. Jeffrey Gundlach, you think he's some altruistic, like very charitable guy and stuff? He's a great guy. He's very smart. Yes, the market's going to test this low again, 2200. Well, Jeffrey, you'd have no idea if it's going to do that. I have an idea it'll do that. It'll do that only if we have a major resurgence and a spike in coronavirus deaths and and basically COVID-19 doesn't slow down but spikes higher. Then the market, then the economy is no longer reopening. They'll be reclosing again. In that case, yeah, technicals can break. In the meantime, let's focus on technicals. Don't overthink this. Don't overthink it. And I repeat, ask yourself how long you're going to be shit scared all the time and missing massive trades. We're traders. I'm a professional trader. I pay my living, my bills, my excellent son, my beautiful wife, our great rescued pets, our cars, our houses. All my bills are paid through what I do. So you think I'm some stupid guy on StockTwits or some other trading forum that you're looking at who's babbling away and posting 900 times in 9 minutes? No, exactly. So let's look at this here. 1,300 points. So it's quite a bit. So what are we seeing here right now? Again, we are back. We're heading back towards getting back to the upper end of the channel, which we said was 29. What did we say it was? 1 second here. Somebody remember? Okay, so memorize that. Okay, basically upper end of that is 2960. Let's call it 29. Yeah, let's call it 2960. So if we get 80 points from here, times 8, that's 640 points. Do you think that can happen this week? Yeah, it can happen this week. Yes, it can happen this week. And you're going to be still sitting there saying, oh no, is it going to
Frank,
happen?
if you want to be a little bit more optimistic, you could say it could break out as well too. It's tested that level a few times.
Hold your horses there, kiddo, okay? One thing at a time. I don't want to be that optimistic. I'm looking at it purely from a technical trader, even though we're in the same mental thought, my friend Paul and myself. I do not want to be that optimistic. I'm simply saying that we can go up 640 points. And I'll tell you why I agree with you, why there's a high probability, because there's a probability scheme of why we can break out. And I'll give you a very simple reason, aside from the economic reasons and all that stuff, okay? Look at Apple. Apple's reopening their stores. You think Apple's not going to surge? Of course, people are going to go nuts. Just the euphoria of being in an Apple store. They'll buy like frigging 2 phones instead of 1, just for the hell of it. Okay, so bottom line is, and that's going to drag the market higher, more. So my point is, you got 680 handles times roughly 8. That's 640 points on the Dow Jones Industrial Average, and that should take us back into the low 24,000s. Okay, 600 points from here. So bottom line is that one of the things, simple rule of the thumb, and it doesn't mean that it's a rule that has to be followed and obeyed by the market all the time, but I've seen it happen way too many times, and this is why Paul might very well be right, is the fact that the more you hit a particular resistance, that it's like, the physical law of nature, you keep on hammering away at the top of at this wall, chances are we're going to break out. And the next breakout will be at 3014, which is the sideways moving 200. Actually, the 200-day moving average is 3,000. How psychological is that? The 200-day moving average, that's this white line here, is 3,000 psychological barrier. We cross over 3,000. There is, again, a lot of CTA funds, quant funds will get heavily squeezed, as they're getting squeezed tonight. All right. And look up on Investopedia what CTA funds are, commodity trading accounts. Okay, they are big S&P players, futures players. So big positioning, and mostly on the short side, obviously, most of the time. So bottom line is, yeah, the more you hit a certain a resistance, chances are you're going to break out. Just the way if you keep on hitting a certain support repeatedly, then that floor starts to weaken. If it holds, then you get a significant bounce. But if it doesn't hold, as if it weakens, the chances are you drop to that 2634 level, which was the inverse head and shoulder neckline breakout that we identified and played like a fine violin, okay, back in late March, early April. While again, the same talk was out there. Oh, markets, it's a V-shaped recovery. It won't last. Blah, 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 blah. Okay? So ask yourself before you go to bed, how many times does your brain say blah, 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 and you just sit there like an idiot and not make money? Exactly. Be truthful to yourself. The truth shall set you free. But don't tell anybody that. Just talk to yourself, all right? Don't tell, hey, I was real stupid, this and that. No, no, no. Act like you know what you're doing, all right? And get in the act of making money. So this was the neckline, the breakout, and that would be a major floor, and that and markets tend to do that. Now we're not there, so I'm not going to sit there and prognosticate what's going to happen. If we hit this again, which is a 50-day moving average, and break below sharply, can happen, mind you, anything can happen. But we don't live life on anything can happen. We live life on what we think will happen on a probability basis. And at this point, it's pretty clear that we want to head towards the upper end of the range, where it's going to be met with some pretty heavy duty selling. Heavy duty selling. And that heavy duty selling might pull us back a little bit lower and then jettison us higher. But if we keep on knocking on the 2700 level, then there's a high probability we're going to come down. And the first level of contact will be 2634, which was the inverse head and shoulder breakout back on the first week of April. Everyone with me so far?
Yep.
Yes. Okay, good. Now, we will look at the Russell 2000. And unfortunately, I can't show you the futures because they don't give it to us. So let's look at the Russell 2000. What's going on here? The big asset allocation into regional banks, financial, small biotechs, and many, many other companies which are considered to be US small cap is a significant factor. And that's a good thing. So the Russell 2000, as I've shown, has lots of gaps. Lots of gaps. Each of these dotted lines are gaps. All right. And what I like, one of the things I like about from an option standpoint in making money is IWM calls are very elastic. In simple terms, what is elastic? They are price sensitive. So if the IWM goes up from 124 to 125, those options jump. There's no lag period. They just jump. Okay, so you can buy cheap calls, whether it's $1, whether it's 86 cents, as was the case on Thursday, Wednesday, and they can go up to $2.50, $3. So you can afford to buy a bunch, take some staggered profits along the way, and be a happy camper and move the strikes higher. So it doesn't break your back to buy them, because a lot of the times the SPX, the SPY, not the Qs that much, but the SPX, the SPY, those ones being the more heavily traded options class, both on the call and put sides, they're pretty steep. They stuff the premiums. So the Russell 2000 at this point has a major downtrend line, and let's fix that properly. At 1 second. Major downtrend line, which is actually, I will do it here. That's better. Okay. So it was doing quite well till the 11th. What day was the 11th? The 11th was last Monday, and then we got thumped, not just on the Russell 2000, the overall market. So we got thumped. There were 2 days of big selling, and guess what it did? It bounced off beautifully off the 50-day moving average. Look at that, 50, and this is the actual ETF, 50-day moving average right there. It crossed through, and it just didn't even stay there. It crossed through, it bounced off that, came up nicely, and then the following day, which was Thursday, the 14th, it fell below the 50-day moving average. You heard screams of like, oh my God, out there, from the media pundits, look at the Russell 2000, it's on a breakdown mode, but not on the technical charts. On the technical chart, and this is the day the market turned around from being down 600 to being up 377. If you guys remember, it was Thursday. We called it, not just on the IWM, on the overall market. It was ferocious, ferocious. So you have to respect it. So this was Thursday. Retested, stayed closed right above the 50-day moving average, this line, and overshot. So this was Thursday. Then come Friday, we had an initial pullback in the morning, walked you guys through it, showed you the VIX repeatedly. There was a big slam down pretty much right off the bat on the VIX after it hit the second major resistance. Couldn't even get to 40. And it's not about numbers, it's about charts. And my charts are there on the Twitter feed. I'm not going to spend 11 p.m. on Sunday night re-explaining that because it's all there. If you guys are serious about making money, please feel free to look at that stuff that I've already published. And I walked you guys through the VIX, called the VIX to the teeth, and those are big predictive calls. I don't think there are too many trading services who make this type of major predictive calls. What's the favorite line of most trading services out there? A lot of them are very smart. I don't think they're smart about the market as we are, but they're smart as traders. But they don't make that big money because they never make any predictive bets. What's the famous line? Hey, Rob, next time get a mic, all right? Because I want to hear from you. They say, trade what you see. What a bunch of crock. Because by the time you trade what you see, it's no longer to be seen. This is they say in grandpa's market, okay? Where price patterns and stuff will tell you exactly where something's going to go, especially when it comes to fast-moving indices and fast-moving stocks. The algos know very well what you're seeing, so they will make you unsee what you're seeing. And you'd be like, what? That's called structured volatility. This is a different world. You got to get used to it or get the hell out of this business. The algos will never let you see what is obvious. And that's the reason why we're so good at what we do. This is not the first time. Do I rest on my laurels? Absolutely not. I am always vigilant. I am always alert. I'm always flexible. And like I just spoke to my friend Paul here too, I am not overtly bullish. I am tactically bullish. I have no idea if we're going to break the upper end of the range. I simply said we got another 600 points to go or so, and then we'll see what happens. Now, saying all that, the Russell 2000 has a funny looking 5-day moving average. I find that to be pretty funny looking. Now, this 5-day moving average also happens to be at the cusp of the 20-day moving average right there, the blue line here. So just follow the lines here. If we can break out over 126.57, giving it a little leeway here, then we have a fair shot to get back to 130, which is that monumental downtrend line at this point. Before it was 133. We played those very well, if you all remember, last week. And then you have the one, now it's at 130, the downtrend line. It's downtrending. If we break out over that, the next move is 133. If things go really well and we do not have and I'll keep this real simple, if we do not have a sharp spike in coronavirus cases, deaths, and other unfortunate events, a spreading of the virus, then we are going to hit we're going to hit the lower end of this gap. We're over this gap right now, which is 137. Do you know what kind of percentage you're going to make? You're going to make more than 600% on your money between now and the end of the month, because there's always a 1 week window or so when cases flare as the economy reopens. What if it doesn't flare? Think about that for a minute, because the virus, just like any other virus, is very contagious within the first 24 to 72 hours. So a lot of people out there partying, enjoying the weather, massing in crowds. If we do not get a spike in the virus, and write it down somewhere, write it in your mental mind, okay? Right now, mental whatever you have up there. And go tell your friends that I said that. That if we do not have a huge flare up within the next 24 to 72 hours, this market's going to rip the lungs out of the dogmatic bears. Again, there are risks to the market. It's not just the virus. We are, for political reasons, we are at least starting another battlefront over the China trade situation, which we went through heavy duty volatility last year, if you remember. However, I do believe that this is a high level game of poker that President Trump plays with the Chinese. We have a big meeting tomorrow, the World Health Organization, and China is going to get slammed for some deficiencies that they had when the virus was first detected. I in no way or form believe that they unleashed the virus on the world. I do believe that they were, for whatever reason, not transparent. And more importantly, leaving all the political conspiracy theories aside, we are starting a mini high-level tech battle with the Chinese, which is not going to be conducive to the chip companies, despite the fact that they reversed. It's not going to be conducive to a lot of other companies, and we've seen that playbook happen over the past year and a half. So nothing new about that. So the NASDAQ could be a little bit vulnerable. Not the software companies, but primarily the chip companies, the suppliers, and all those type of companies, which are heavily weighted on the semiconductor index, and also on the NASDAQ 100. So keep that in mind, okay? That's an element of risk. Nothing to do with the IWM. They primarily US based. Nothing to do with the biotechnology companies. They're primarily US based. All are US based. Okay, so there is an element of risk on the NASDAQ side. So keep that in mind. The Chinese are, also going to hit back, all kinds of stuff, and it'll be a little bit of a mess. So that's why I'm saying I'm not overtly bullish, all right? But these kind of things happen. We have to take it the way it goes, and we'll see what happens. So saying all that, that's it. It's pretty clean and simple. Now, here is the up acceleration channel right there. If we entered that and we break out over this, then there's like I explained. I don't want to get too crazy and say, oh my God, we're going to get to the upper end of the channel. But let's do a day count, ladies and gentlemen. Are you guys with me so far?
We're with you.
Yes.
Okay. This is money in your pocket if you act on it. Well, that's what I do most of the time. It's mostly money in your pocket, but if you don't act on it, what are you going to do? Ask Nancy Pelosi for money? So anyway, so let's do a day count as to how many days it normally takes from the lower end of the channel to the upper end of the channel. Very easy stuff. Let's call this the first day. 1, 2, 3, 4. That's pretty fast. That was back in, that was when the market bottomed, so it was very fast and furious. Let's start here. 1, 2, 3, 4, 5, almost to the upper end of the channel. Okay, we like that. Here, there was no upper end of the channel. It didn't even get down there, so this went on a sideways bend. So let's start off with here. Here. We were very close to the lower end of the channel. So how many days was that? 1, 2, 3, 4, 5. Here we were still quite distant from the channel, but it took 1, 2, 3, 4, 5, 6, 7. Here, we're attempting to re-enter the channel. So let's say we get into there and we actually follow some of the past pattern symmetry, then it'll be roughly 7 or 8 trading days, not calendar days. You guys should know that by now. 7 or trading days. Let's call it 10 trading days, which will bring us towards the latter part of the month to get up here. Can that happen? Yes, it can happen. That's a lot of money. Now, in between, will it be a straight line? Absolutely not. There'll be red days. There were red days along the way here too. Okay? But we would like the trajectory to be like this. Okay? So that's like a pretty simple thing to look at. Now that's your external side. Let's take a quick look at the internals, which would be the full stochastics, and that looks pretty good to me. We needed to cross over the percentage K, and we need to basically have, in simple terms, for people who are non-technical, which is totally fine, we need the white line to cross over this orange line, and bang, it goes. McLaren oscillator on this side, looking pretty okay to me. Needs to basically climb higher. So the IWM has to be watched for reasons and for all these things. And this is the swing picture of what happens. Now, let's take a look at this is your intraday volatility, which map that I show you guys all the time. And when these crazy sell-offs come and everybody's just panicking like no one's business, and don't tell me you guys don't panic, then this is what you have to follow. These are supply demand levels, resistance, supports, blah, blah, blah. Let's take a look at the 15, that's 1 hour. So let's take a look at, I did this on Friday, and that was the Fibonacci retracement. Fibonacci retracements on this platform, on the investing.com platform, which I know if you guys can use on any time for free, is the dotted blue line is always the Fib 50, Fibonacci 50. Don't know what that is? Go to Investopedia, read up on it. So, saying all that, told you we'd get to the Fib 50. We broke above the Fib 50, Fibonacci 50 level at 3:45. Actually, first broke out of it at 2 p.m. on Friday. Hallelujah. Kiss the chart. Okay, that's 2 p.m. Friday. Well, a lot of you might have been cowering in fear, like, oh my God, should I buy? Shouldn't I buy? Is it all over? Blah, blah, blah. Okay. So, 1 second. So, then we closed at 4 p.m. right there. That was 4 p.m. That was the 4 p.m. close. That was one sell candle. You know, sharp one, nothing crazy. We lost from 28.59 down to 28.45. That's 14 handles in one go on the last 15 minutes of trading on Friday. Who the heck cares? Did it change the overall pattern? Did it not still be at kissing distance of the Fib 50? That's all I needed to know. That's all I needed to know. And I can bet you a good number of active retail traders and other hedge funds and stuff too, the big shots, went short on that candle. And now they're dying. And they won't be lucky if we open down tomorrow morning for whatever reason. And anything can happen, but I'm just saying. But right now, those hedge funds who went short E-mini futures at the close on Friday are covering hard. That's the reason, thanks to Jerome Powell and his powerful statements on CBS's 60 Minutes about the U.S. economy, and that they have enough tools to keep the U.S. economy for more stimulus, that they're short covering right now. You don't jump up 34 handles because you're not short covering. Okay? So that's it. So when you look at this chart, first thing you have to do is, as I That's the only reason why I drew it for you guys. I draw these charts, I mean, I draw charts for myself all the time, but I'm sharing this with you guys, with you fine individuals, is because I want you to understand. So that this is what I was seeing. This was the 12th. 12th was a Tuesday. Big sell-off. Massive turnaround on the 14th. And it was it was clear as daylight that this was an inverse head and shoulder with a right shoulder here with multiple left shoulders here. This is not rocket science. If you kill the demons in your head, you see these things pretty clearly. But there's all these critters in your head like telling you, oh no, we can't do this. Head. Okay. What's so difficult about this? You can't understand, you can't trade volatility charts. This is not a VIX chart, but I'm just telling you. And then on top of that, I'm showing you the VIX slam downs, internals on the S stocks, slow stochastics, and all that stuff, which is the more advanced predictive stuff that I show you guys just so you keep your head straight. Look, no one's asking anybody to be a stupid bull, certainly not a dogmatic bear, because both sides will get killed in this type of market. Just stay calm. Stay robotic. The only way to suppress your emotions is not by talking to your grandma or calling Oprah or Dr. Phil. Okay? Or whoever you talk to. The only way you would suppress your emotions as a tactical trader is by truly delving yourself and going deep inside these amazing structured charts that are produced and your own charts that you produce. That's the only way you'll suppress your emotions. So emotions that humans are not designed, our genes are not designed for calmness. Human genes are designed for fight or flight. You either fight your enemy or you run like a wild man. And sometimes you gotta run like a wild man. Okay? You got a big grizzly coming at you. You don't want to fight that grizzly, okay? Unless you got some serious firepower. You want to run. But human beings are mostly designed just when a big obstacle hits them, they just like, oh my God, I'm gone, boo. All right? So use these charts to suppress your emotions. So this was a very clear inverse head and shoulder. One or the other on any big drop in the market, 90+% of the time, within a matter of 24 to 48 hours, on a short-term move in the market, this was a 1-week chart, right? You will get back and retest the 50-day moving average. It's almost a given. And I've shown you guys that hundreds of times. I don't even need to ask anybody. And once it hits that, then it either falls back again, maybe creates another shoulder, maybe it doesn't. But one with the other, it gets there. And it got there real fast. So you could have made a lot of money on this move and said, okay, I'm going to set aside. Hey, that's a strategy. So now we're up here. Now this was, this line was drawn. Remember, these charts are not drawn after the fact. And that's something Mr. Anderson here will understand. Anderson, your free trial is going to be over in literally 2 or 3 days. So join us and do well, or good luck with everything you do out there. So, so bottom line is that this chart was not drawn after the fact. It was drawn before the fact. So you have this big supply zone right here from pre-market on the 13th, and that's what we are above that right now. Can we drop below that? Sure we can. But what really comes into play is this. If we drop from here at 28.83 to 28.50, that's 23 handles. 23 handles times 8 is roughly 164 Dow points. Is it not possible we can drop 164 Dow points within the first 2 hours of trading tomorrow morning? Absolutely. So as a tactical trader, you want to scalp out a significant amount of profits. Like I say, full or partial profits. That's code for, hey, take a bunch of money off the table. You're opening up 36 handles right now. It's 36. Let's say the market opens up 36 points handles higher on the E-minis. You're not going to take profits? Okay, whatever you want to do. I will. And then I'm going to sit back, see how the market reacts. I'm going to get back on higher strikes. It's very simple stuff. A child can do it. In fact, a child would probably understand it better. Okay, so all of a sudden, can't the market give back 164 Dow points and retest the 50? Absolutely. And how many times have we seen that? And how many times have some of or many traders out there, maybe some of ours, hopefully not, sat there and given back fat profits because they were too greedy or too lazy to take profits off the table in the first 15 minutes? Don't do that, because when you do that, it plays games, and your confidence is shot. You're like, what the F, I was up a couple $100, I was up a couple of $1,000, and now the market's just taking it back. Now I got to regroup and see whether it holds. I got a dollar cost average. That's just a lot of work. So why not take some profits off the table if we open up higher? That's it. It's very simple. Now, this pattern here up to 29.40, and we looked at 29.62 on the other end when I was discussing the other chart. Will it happen like right away? If the world just completely ran 110%, 100% on technical dynamics and exact price pattern structural symmetry, then yes, it's going to happen like literally by Tuesday. Now, I've said it before, and it's happened. If we get a very sharp run up into Tuesday, you want to be out of some very nice profits. Sharp. I'm not talking about selling everything. I mean, managing your own portfolio is your own business. I'm talking general fast-moving stocks, indices, things like that. I'm not talking about the swing trades and things like that. You want to be out of that, because what will happen on Wednesday? Wednesday is hump day. Wednesday is options reset day. Wednesday is when the institutions, market makers, and the algorithmic high frequency trading machines want to suck out and burn your premium because you're too greedy not to take profits. So Wednesday is generally a red day. Did you guys understand that part? Like loud and I know some of you have heard me say that before, but I'm telling you right now. So whichever the case, do I think it's a straight line up? Well, let's put it this way. I'm not a crazy bull. If it happens, then hallelujah. Great. But I will certainly take profits on the market opening higher. And then I'm going to regroup and buy some higher strike and scale in, not put everything that I took out back in. Put 1/4 back in, nibble a little bit. The market's going to zigzag. And this could very well happen. The perfect thing for tactical traders is we open up here, up 36 handles on the S&P 500, because this is a major resistance. We immediately pull back 170 points. You got fat profits put on the side on multiple trades. If you positioned yourself last week, especially on Thursday and Friday, and then you say, and then the market bounces around here, so you buy them back cheaper. Or even a retest of the downtrend line, slip and slide at 28.40. That would be perfect. Chasing a train like this and trying to get in here has a 90% probability of you taking a loss. Exactly. Trying to jump on a speeding train is not very conducive to your sanity or to your health. However, fast traders can certainly, get in halfway up here if we get another big surge by Tuesday, and make money. I'll certainly get in if I start to see it move, but most traders will be like starting to feel like a little bit comfortable, right? Comfort is your enemy. Think I'm kidding around? Especially in options trading, comfort is your enemy. That's exactly when you're going to lose money. Discomfort is when prices are the cheapest. Real discomfort is when prices are at the cheapest, right here. Charts will give you the level of tactical comfort to realize that these are your entries. Look at that uptrend line I'd drawn. It almost touched it and then bounced. Came back, almost touched it, bounced. These are the points of maximum discomfort for traders, human traders. And that is the perfect time to buy, as long as the charts are cooperating and as long as the patterns are right and blah and all that good stuff. Points of maximum comfort and feeling good is when you want to ring the register and take some fat chunks of money off the table. Let the suckers out there get sucked in here, because right around 29.40 at this level or so, they will hit the market again. And hitting the market doesn't mean we have to come all the way down here. Hitting the market means you could easily drop, like I said, 200, 300 points fast. That's all I got to say. Guys, have a beautiful evening. It's going to be a great week. Stay tactical, less emotional. Focus on these incredible real-time tactical charts. Tell all your friends what we do here. And if you're a free trial subscriber, don't be scared. You really want to learn to see the market in a matrix and not the old-fashioned way that you've been looking at it? It's no fault of your own. Then join us here at Clueless A Trading. Spread the word, guys. Let's have a killer week. There's a lot of stocks on the move. I don't want to get into them right now. It's all on my Twitter feed. Still liking Moderna. Still liking Regeneron. Still liking Apple. Still trading Netflix. Not even liking or hating. Still trading Netflix. Liking Tesla. Not actually liking Tesla. Trading Tesla. Okay? Trading Tesla. Some new names like the Mini Teladoc, ONEM, One Medical, NVIDIA, Paul's favorite, keeps on going higher. But remember, that element of risk is there. You start a full-scale chip war with China. Unfortunately, those companies will get hurt. Teladoc still good, even though you got to trade it. Still like Beyond Meat. Then there are other names that that I put out there. I still think Grubhub gets bought out. I keep on buying the cheap calls because the initial run-up was fantastic, took some nice profits, and now I'm down on those calls. But I dollar cost average, they're freaking 30, 40 cents. Who cares? They get bought out, I'm getting paid $3. So I don't want people sobbing and saying, oh, do you think it's going to get bought out? Yeah, my answer is yeah, I think it's going to get bought out. Like lengthen the calls. Wix, that stock's going to 250. Shopify never stops, which is really crazy. But then it's a serious company. And a smattering of names. Anthem Health, where we took the calls from 75 cents to $5 just early part of last week on my Twitter feed. Novavax, big winner for us. So that's it, guys. Welcome to America, which is built out of risk and grit and being smart. You want to live in fear and doubt and that you're going to die now, then what can I say? Subscribe to another service. Have a good one, guys. Love you all. Thanks for attending so late. Have a great evening.
Good night, man.